Welcome to the deep dive, where we strap in and tear open the latest corporate filings and industry reports. We pull out the key insights so you don't have to.
And today, we are focused squarely on the engine room of the economy. We're going deep on J.B. Hunt Transport Services, Inc.
Specifically, their fourth quarter and full year 2025 results. They dropped back on January 15th, 2026, and there's a lot to unpack.
There really is. And this deep dive is built around a really fascinating puzzle. I mean, for you, the listener, the core question is this. How did J.B. Hunt manage to massively boost profitability and their earnings per share?
That all-important EPS number.
Exactly. How did they boost it by so much when their overall revenue actually went down? We're going to get into the segment data to find out how they did it.
It's the ultimate proof that the top line, that revenue number, it isn't always the whole story. So let's start with those headline numbers. We're looking at Q4 2025 versus Q4 2024.
Okay.
Total operating revenue came in at $3.1 billion. Now that's down 2%. And on its own, that sounds like a company that's, struggling a bit.
It does. But, you turn the page, you look at the bottom line, and the picture just flips entirely. Operating income surged to $246.5 million. That's a huge 19% increase year over year.
19%, wow.
And then the number that really gets analysts excited. Diluted earnings per share, the EPS, hit $1.90. That is up a remarkable 24% from $1.53 the year before.
That is just aggressive internal execution. I mean, they didn't just tread water, they sprinted on the profitability side.
And the full year trend holds up too. For all of 2025, revenue is down 1% to $12 billion, but operating income still climbed 4%. EPS was up 10% to $6.12.
So that gap between revenue and profit tells you everything about their priorities right now.
It really does. The CEO, Shelley Simpson, she highlighted the team's ability to, and I'm quoting here, finish the year with another quarter of strong execution and financial results. The focus wasn't fighting for revenue in a soft market. It was all about operational excellence.
And structurally lowering costs.
Exactly. Driving that long-term value.
Nice. Okay, let's unpack that 19% jump in Q4 operating income. Because when a number moves that much, especially while revenue is falling, you have to ask, was this a real structural win or was it just some kind of lucky accounting fluke?
It's a bit of a mix. And the nuance here is really key to understanding the health of the business. First, you have to look at that prior year comparison.
Okay.
Because in Q4 of 2024, their operating income was hit by a pre-tax charge of $16 million.
Right. That was for intangible asset impairments. So high-level finance speak. Are we basically talking about them having to write off a bad bet from last year, maybe a tech platform that didn't work out?
That's a perfect way to put it. You're just removing some noise from the prior year's number, which makes the growth look a little bigger. But, and this is the important part, even if you strip that out, the underlying operational gains were still phenomenal.
So what was the real story?
The real story is that they executed initiatives to structurally lower their costs. They improved productivity across the entire organization, and critically, they had significantly lower personnel-related expenses.
Okay, when a big company says lower personnel-related expenses, that always makes my ears perk up. Is that a sign of fear for 2026? So layoffs? Or is it more about managing headcount, attrition, a hiring freeze?
Well, based on their messaging around structural cost reduction, it points more toward aggressive management of attrition, belt-tightening in the back office. Not so much panicked, widespread layoffs. They just got leaner.
But it wasn't all easy wins.
No, not at all. They still had to absorb higher equipment costs, and fuel expense was a bigger percentage of their revenue. But the key is that the efficiency gains just far outpaced those pressures.
And those gains had to come from their biggest segments. So let's start with Intermodal JBI. That's about half the company's total revenue. This is where things get really paradoxical.
The JBI data is a perfect case study in strategic retreat. So look at the Q4 2025 metrics. Revenue was $1.55 billion, so down 3%.
Okay.
Load volume was down 2%. And the revenue they charge per load was also down 2%. So if your volume is down and your price is down.
How on earth do you boost your bottom line?
Exactly.
And they boosted it big time. Intermodal operating income was up a massive 16%, hitting $135.5 million. This is incredible.
This is the direct result of focused network optimization.
Yeah.
If you really dive into the load data, you see this shift. Their transcontinental loads, those long, complex cross-country runs, they decreased by 6%.
Okay, so fewer long hauls.
Right. But at the same time, their eastern network loads increased by 5%.
So they consciously decided to sacrifice some of that longer haul, maybe less profitable freight for shorter, more manageable eastern loads. Why is that specific shift so powerful for their profit?
Because it fundamentally changes their cost profile. A huge chunk of logistics costs comes from inefficiency. Specifically, moving empty containers around and paying to store them.
Right, empty miles, the silent killer of profitability.
The silent killer, exactly. So by focusing on network balance, especially in that dense eastern network, they improve their drayage efficiency. That's the local pickup and delivery part, and just lower their cost to serve.
Fewer empty container moves, lower storage fees.
And that translated directly into that 16% income boost. It was a clear choice, quality and profitability over just the sheer quantity of freight.
That's a perfect example of finding profit when demand is soft. Okay, so let's shift gears a bit. Let's look at the segments that show some contrasting market dynamics. Starting with dedicated contract services, or DCS.
Right.
This is J.B. Hunt's bread and butter, right? The stable performer. Did that hold up?
It absolutely did. DCS is all about those long-term custom contracts, and its performance reflects that. Revenue was up 1%, and more importantly, operating income was up 9%.
And that 1% revenue increase, where did that come from?
It was driven entirely by a 1% improvement in productivity. So
Right.
revenue per truck per week. They were just doing slightly more with the assets they have.
And how did they manage that?
It was fueled by their contracted index-based price escalators. Think of them as automatic price increases tied to things like inflation. They're locking in margins. Plus, they have a fantastic customer retention rate, about 94%.
So DCS is just the solid foundation that keeps the lights on.
It really is. They're squeezing more value out of fewer assets.
Okay, but then you jump over to the truckloads segment, JBT, and it's a completely different world. This looks like a desperate fight for market share.
It does. Revenue was up 10%, but that was driven by a huge 15% increase in load volume. They clearly just wanted to move freight, almost no matter the cost.
It's a volume-first strategy, and it
Right.
must have come with a trade-off.
A heavy trade-off. While volume soared 15%, the revenue they actually earned per load, excluding fuel, it decreased by 4%. They were basically buying that volume with lower prices.
So if you're accepting lower prices for higher volume, profitability has to suffer.
And it did. Operating income was down 2% to $8.4 million. It's a classic case of doing more work for less money.
What was squeezing them?
The primary reason was the market itself. It was signaling tightness through higher third-party purchased transportation costs.
So they had to pay other carriers more to move the freight than they could charge their own customers for it.
That's the squeeze. And it's a massive market indicator we need to keep an eye on. But it seems they're playing the long game here, trying to lock in that market share for when demand returns. We also saw their JB Hunt 360 box volume was up 11%, so the digital platform was working, but couldn't offset all that cost pressure.
Okay, let's move to the brokerage side, Integrated Capacity Solutions, ICS. This is always the most volatile segment.
It is, and on the surface, ICS shows this really dramatic improvement. They cut their operating loss from a staggering $21.8 million in Q4 2024 to a much smaller $3.3 million loss in Q4 2025.
That looks like a huge turnaround.
It looks like one.
Yeah.
But if you look at the actual operations, the market was just not cooperating. Revenue was down 1%, and volume actually declined by 7%.
So wait, how did the loss shrink so much then?
It was mainly through internal cleanup. Lower personnel costs, a drop in bad debt expense. They basically got leaner and better at managing their own risk.
Right.
But the profitability per load actually got way worse.
How much worse?
Gross profit margin fell from 17.3% all the way down to 12.4%.
Oh, wow. Why such massive margin compression?
Two main reasons. First, a lack of the high-margin project work they had the year before. And second, that same old story we saw in truckload. Elevated purchase transportation costs because of tighter market capacity.
So the market is squeezing them, but management's just getting better at running a leaky ship.
Exactly. They're plugging the holes, and they're still investing for the future, too. They increased their number of third-party carriers by 15%. They're positioning themselves for when the market eventually turns.
And finally, we get to final mile services, FMS. This looks like the clearest sign of softness in the general consumer market.
FMS took the biggest hit of the quarter, no question. It was a clear signal of weakness at the consumer level, revenue down 10%, operating income plummeted 43%.
And to translate that for you, the learner, FMS is what handles the delivery of big things, appliances, furniture. When that revenue drops 10%, what is the consumer telling us?
The consumer is telling us they're delaying those big-ticket purchases. People are still buying groceries,
Mhm.
but they're holding off on replacing the fridge or buying a new sofa. That hits the last-mile sector hard.
Okay, so let's step back from the segments for a minute. What does the overall balance sheet tell us about their capital strategy? Because that's the final piece of this puzzle that explains the huge boost to EPS.
It tells us they're running a very conservative ship. They're conserving cash and prioritizing shareholder returns. On the debt side, their total debt was basically flat. They're not loading up on debt.
And their internal spending slowed down too.
Significantly, net capital expenditures,
Mm-hmm.
they came in at $575 million for 2025. That's down from $674 million in 2024. They're spending less on new trucks, new infrastructure.
So that reduction in capital spending, that's a really powerful signal. But then they took that cash they saved and used it for massive share repurchases. Why do that instead of, say, a big dividend?
It is a very deliberate strategy to really maximize the effect of all that operational efficiency. Share buybacks are the most effective way to shrink the denominator in that earnings per share calculation.
Right, you're dividing the same amount of profit by fewer shares.
Exactly. So every dollar of profit they generate gets spread across fewer shares, which results in a higher EPS. It's a way to immediately reward shareholders.
And the numbers here are huge.
Oh, they are. In Q4 2025 alone, J.B. Hunt bought back 843,000 shares for $140 million.
Just in one quarter.
Just in the fourth quarter. And for the full year, they bought back about 6.3 million shares for $923 million. This financial engineering, it's the engine that took their modest operational growth and turned it into that massive 24% EPS increase in Q4.
So what does this all mean for you, the informed learner? I think the takeaway is a clear shift in the playbook. When the market gets soft and revenue dips, the company's main engine for growth becomes internal efficiency and just radical cost control.
Exactly right. J.B. Hunt stopped chasing volume that just wasn't profitable. They're managing to grow earnings by optimizing their biggest segment, intermodal, through that sophisticated network balancing. That's the real hero of this report.
And at the same time, they're running a riskier volume-based strategy in truckload.
A high-stakes strategy, yeah. They're trying to capture market share, even if it means eating those higher transportation costs for now. It's really a dual strategy. Optimize what you can control, like JBI efficiency, while accepting the reality of the volatile spot markets in truckload and brokerage.
It's a pragmatic but really difficult balancing act.
It is. And this brings us to the final provocative question for you to think about as you track the logistics sector into 2026.
Okay.
We saw these consistent signals in truckload and brokerage that the capacity market is tightening. That's what those rising transportation costs are telling us. So if the truckload market continues to tighten, forcing J.B. Hunt to pay even more for capacity, how successfully can they keep executing these cost-saving initiatives and maintain these strong operating margins? That tension between internal control and external market pressure, that's what will define their next year.